Global corporate tech relies on a massive offshore machine that never stops. But right now, the market is betting someone will pull the plug. This chart tracks Indian IT sector valuation. For 10 years, investors reliably valued these companies at roughly 25 times earnings. But here, valuation falls off a cliff, dropping to 19. Markets reprice this violently when they suspect the core business model is dying. For decades, this sector grew on a very simple math equation: billable hours. If a client needed a piece of software built, the IT firm hired human engineers to write it. Revenue growth was directly chained to adding more headcount. Now, introduce artificial intelligence. If new AI tools allow a single software engineer to output the code of 3 people, corporate clients are going to demand smaller teams and cheaper contracts. That directly attacks the billable hour foundation. Investors are terrified of one specific outcome. Artificial intelligence might permanently compress the amount of money there is to be made in IT services. To figure out if this fear is justified, we have to look backward. This industry has actually faced an identical apocalyptic panic before. In the late 1990s, the sector was supercharged by 2 massive tailwinds. First was Y2K. Every major corporation on Earth scrambled at the exact same time to fix their computer systems before the millennium. Immediately following that came the dot-com boom. Suddenly, traditional enterprises and massive internet startups were throwing millions of dollars at rapid, aggressive software development. Then the bubble burst. As the NASDAQ crashed, global clients panicked and instantly froze their discretionary technology budgets. The easy, infinite project work evaporated overnight. The narrative on Wall Street solidified immediately. Indian IT had lost its only growth engines. The era of massive tech spending was dead. We can see the scar left by that panic on the far left of our chart. Between 2001 and 2003, the sector's valuation was brutally compressed, dragging it down to a historic floor of just 12 to 15 times earnings. The bears trading the stock down in 2001 were actually entirely correct. Y2K and the dot-com boom were gone forever. Their mistake was assuming nothing would replace them. The recovery did not come from a sudden return of dot-com spending. It was triggered by the immense cost pressures of the crash itself. Western companies simply could not afford expensive domestic developers anymore, making offshore IT a mandatory board-level strategy. The sector evolved. Instead of doing one-off software projects, Indian IT firms began taking over entire multi-year global back-end operations. They converted a temporary crisis into a permanent structural growth phase. Fast forward to today, and the market is asking the same question about AI. Will this new technology permanently shrink the revenue pool, or is it the next hidden growth engine? The optimistic case lies in the mechanical reality of enterprise software. You cannot simply plug an off-the-shelf AI tool into a Fortune 500 company's legacy system and expect it to magically replace a workforce. Before an AI can do anything useful at a corporate scale, companies have to undergo complex, painful transformations. They have to scrub decades of messy raw data, redesign their internal workflows, and build strict security and compliance guardrails. Even if that final AI node operates autonomously, building the massive foundation underneath it requires millions of hours of human labor. Executing complex, multi-year operational heavy lifting is the exact problem Indian IT was built to solve. If they capture this enterprise transition, the effort required to implement AI will expand their market, not shrink it. A stock's valuation multiple maps human psychology and market anxiety just as much as it tracks actual cash flow. Look at the full scope of our chart. The dot-com panic dragged valuations to a floor of 12. Today, we sit at 19. This gap shows the market is pricing in AI concerns, but not the total destruction of the industry. Still, buying a stock just because it is trading below its 10-year average is dangerous. If the core business model is actually dying, a cheap valuation is just a trap. To know if the bottom is in, investors have to stop watching the price-to-earnings multiple and start looking at actual corporate deal pipelines. The cycle will only restart when these IT companies prove they can convert AI transformations into scalable, highly profitable contracts. Until those massive deals actually show up in the earnings reports, the sector will stay firmly parked in the shadow of the dot-com ashes.